Your mortgage payment just increased. Again. You open your banking app, same house, same salary, hundreds more leaving your account every month. The headline says, your central bank raised interest rates. Inflation is too high. Demand must fall. Borrowing must hurt. A national decision, made for your national economy. At least that is the official version. Because your central bank does not operate alone. Its governor regularly enters a network of the world's most powerful monetary officials. They compare threats, exchange models, coordinate standards, and roughly every 2 months, many of them meet through an institution in Basel, Switzerland. Its name is the Bank for International Settlements, the BIS, founded in 1930, owned by 63 central banks and monetary authorities, often called the Central Bank of Central Banks. Its members represent economies responsible for about 95% of global GDP. Not a fringe conference, not an academic club, almost the entire system that creates, prices, and protects modern money. The BIS does not press a button and set your mortgage rate. The Federal Reserve sets American rates. The ECB sets euro area policy. The Bank of England sets British rates. National institutions retain formal authority. But formal authority is only one layer of power. The BIS provides the room, the research, the data, the banking services, the committees, the regulatory architecture, the shared language through which central banks understand the same crisis. Governors and senior officials meet approximately 6 times a year. They discuss inflation, credit stress, currency pressure, banking instability, global liquidity, and what happens when one country's solution becomes another country's problem. One core forum is the Global Economy Meeting. It includes governors from 30 major central banks, covering around 4/5 of global GDP. Another 22 central banks attend as observers. They do not need to sign a secret document ordering identical rate rises. Coordination can happen through consensus, shared forecasts, shared definitions, shared warnings. When the same officials see the same risks through the same framework, policy begins to rhyme. Inflation is global before it becomes local. Oil is priced internationally. Shipping costs cross borders. Dollar funding crosses borders. Food markets cross borders. One central bank tightens. Capital moves. Currencies weaken elsewhere. Imported inflation returns through another door. That is how a policy meeting thousands of kilometers away reaches your wallet. Through exchange rates, bond yields, bank funding costs, mortgage pricing, credit card interest. The global system transmits pressure faster than any election can respond. The BIS is not merely a meeting venue, it is an actual bank. Its customers are central banks, monetary authorities, and international organizations. Roughly 200 official sector institutions use its financial services. It accepts deposits, trades currencies, executes gold transactions, manages fixed income mandates, provides liquidity-focused instruments, and operates interconnected dealing rooms in Basel, Hong Kong, and Mexico City, offering near 24-hour coverage. As of 31 March 2026, the BIS reported a balance sheet of SDR 482 billion. Currency deposits totaled SDR 428 billion. This is not ceremonial diplomacy. This is large-scale financial infrastructure. Gold still sits inside this system. The BIS offers official clients gold purchases, sales, swaps, options, safekeeping, and settlement. In 2026, gold and gold loans represented 16% of its assets, including 102 tons in its own investment portfolio. But be precise. The BIS does not publicly claim ownership of thousands of tons of sovereign gold. It provides gold services and holds official sector gold deposits, while its disclosed proprietary portfolio is much smaller. Mystery gets clicks. Accuracy earns trust. The deeper influence sits outside the vault. The BIS hosts and supports bodies that shape banking supervision, payment systems, and financial stability. Their standards travel from Basel into national rulebooks, bank balance sheets, and lending decisions. Consider the Basel Committee on Banking Supervision. Its frameworks influence how much capital banks must hold, how liquidity is measured, and how financial risk is classified. A technical ratio decided far from the public can determine whether your local bank expands credit or rejects it. This is power without a policy speech. No dramatic announcement, no campaign promise, just a revised calculation, a new capital buffer, a new risk weight. 1 percentage point inside a regulatory formula, multiplied across trillions in bank assets. The BIS also possesses extensive privileges and immunities. Its archives and official documents are protected. Its premises receive special protections. Certain officials receive functional immunity for acts performed in their duties. Its assets are protected from measures such as seizure and confiscation under its governing agreements. That does not mean every employee can commit any act and walk away. It does not mean the BIS exists outside all law. Its immunities are defined by treaties, statutes, and host country agreements. Broad, unusual, powerful, but legally specific, not magical. The institution receives substantial tax exemptions. Its charter exempts its capital, reserves, and profits from specified taxation. Its Swiss headquarters agreement also grants tax privileges to the organization and qualifying officials. Why construct a financial institution like this? Because central banks need a neutral platform, a place where reserves can move without becoming vulnerable to every domestic political dispute, a place where governors can speak candidly during a panic. But neutrality looks different from the outside. Detailed discussions from high-level meetings are not broadcast live. Citizens do not watch the debate. They do not vote for most participants. Yet the ideas exchanged can shape inflation policy, banking rules, and crisis responses. Your parliament can debate taxes. Your government can defend its budget. Your central bank may testify publicly. But the international layer sits farther away, technical, indirect, protected by complexity. The more important the system becomes, the harder it is for ordinary people to inspect. Now, the brutal reality check. The global economy genuinely needs coordination. Banks operate across borders. Dollar funding moves overnight. Payment failures spread in seconds. A crisis does not pause at customs because national sovereignty feels offended. Without a neutral clearinghouse for information and cooperation, central banks would enter crises with fragmented data, incompatible rules, and slower communication. In 2008, that could have meant deeper collapse. In 2020, slower liquidity action could have frozen markets longer. The BIS helps create stability. But stability has a price. Monetary coordination becomes concentrated among unelected specialists. Regulatory language becomes too technical for public scrutiny. Legal protections reduce political interference, but also reduce ordinary accountability. The BIS does not secretly control every interest rate. The reality is more sophisticated. It shapes the environment in which central banks think. It helps define the standards banks follow. It moves official reserves. It connects the people who defend the system when it breaks. That is why the phrase matters. Central bank of central banks. Not a world government. Not an all-powerful monetary dictator. An institution sitting beneath the visible layer, where global consensus becomes national policy and technical standards become personal financial consequences. The next time your mortgage rate rises, look beyond the local headline. Your central bank made the decision. But the language, warnings, and architecture surrounding that decision were built inside a much larger network. And its most important address is in Basel.